Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing combining fundamental and technical analysis to master the Forex market. In this video, we will be looking at combining fundamental and technical analysis, which are the yin and yang of Forex trading. Professionals, including institutional traders, tend to take a balanced approach when incorporating fundamental and technical analysis into their trading, whereas some professional traders will lean towards fundamental analysis and incorporate technicals into where they see price going based on current or future economics. However, many retail traders tend to lean towards technical analysis. Traders who wish to become more rounded need to take both of these into consideration in order to be more consistent, and this involves having a good knowledge base of both. Fundamental data releases can offer us a directional bias when trading. As well as waiting for the release, markets will often anticipate price action direction leading up to an economic data release, especially if analysts believe the data is going to be above or below expectations. And therefore, it is important to try and second guess what the markets are expecting in the run-up to the release and where price action will go once the data has been delivered into the market. For example, sometimes market data might be worse than expected by the markets, and yet price action goes in a reverse direction that you might have expected. This is one of the reasons we see a lot of volatility surrounding high-level data releases, which is because people have varying opinions of the effect of the data. However, traders are advised to play the probability game. If the market data release is bad, we should expect bearish price action, and if the market data is good, we should expect bullish price action. If technical indicators subsequently work in line with the data and in line with the fundamentals of the data release, then we should trade accordingly and have pinpointed an ideal entry. This way we will be stacking the odds in our favor for a successful trade. There are many ways to incorporate fundamental and technical analysis into your trading, but in this video we will be looking at 3 methods. Method 1 involves breakout trading with fundamental analysis, which capitalizes on trading when a section breaks outside of its range. Example A. The catalyst for range breakouts is usually due to the release of market data news events, and where such data causes extra volume to come into a particular currency pair and push it outside of its consolidation range into new highs or new lows depending on the nature of the release. Because data releases can cause extra market volatility, it is always wise to err on the side of caution when trading around such events. Previous support and resistance levels can be breached and a great deal of uncertainty can enter into the market at this time. It is always advisable to use a tight stop loss. Example B. Once our support or resistance line has been breached on an economic data release, we can assume that the market has taken the data in one of 2 ways. In this example, we have a dovish stance towards the Canadian dollar, and whereby this particular pair, the USD CAD, has reacted in a bullish direction. Therefore, we have bad economic data coming into the market about the Canadian economy, and this is supported by a price action breaching the line of resistance and where price action subsequently moves in an upward direction, and whereby we should be considering a buy trade. By planning around data releases, we can look for technical breakouts, adjust positions accordingly, incorporating type stop losses, and even use the data release to leave us in the trade in order to maximize our profits. Remember, the art of trading is to latch onto trends because that is where most of the amount of pips are going to be gained. Method 2 combines range-bound trading with fundamental analysis. Example C. Range-bound trading involves identifying a trend with the use of a couple of simple lines, which show us support and resistance levels. These are areas where price is likely to bounce off support or resistance in order to maintain the price action range. Traders use the support and resistance lines to buy support in the ascending trend, and to sell at the resistance line in a declining trend. Example D. This example shows a chart with a strong bearish trend. We do not want any news data release to potentially adversely affect our descending trend and interfere with our profitable trade. Therefore, ideally, we would look to not have open trades surrounding the data releases, especially if they are potentially of a high-impact nature. Therefore, precautions should be taken to avoid trading around high-impact news events. But if you find yourself in an open and profitable trade with a looming data release, which might be of high impact in nature, we suggest you close the trade or partially close the trade or insert a very tight stop loss in order to not reverse the profits you have made on a successful range-bound trade. Method 3. Using oscillators with fundamental analysis. Example E. Oscillators are often used in technical analysis. They are often used to establish overbought or oversold conditions. Here in this chart, we can see one such oscillator, the RSI, or the Relative Strength Index. Example F. By incorporating oscillators such as the RSI, we are easily able to identify areas where price action might reverse having been overbought or oversold. And these coincide with support and resistance lines on our charts, We must be aware of this and be prepared to take the necessary action. However, should these also coincide with new data releases, we should give them extra emphasis, because even if the data goes in line with our chart, and yet our charts are telling us that the market is overbought or oversold, we could see conflicting price action. Please take all of this into consideration when setting up your next trade, and consider adopting some of these methods to use in your trading strategy. Remember that news data releases, especially of high impact nature, can cause extreme market volatility. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.